Hi, everyone. Thank you so much for coming to this class. Tonight, we are going to be talking about the different kind of loan types and why it's important for a seller to understand the difference of each loan type, especially when they are marketing their property for sale. Because when you enter in a listing into the MLS, you choose the types of loans that your client has agreed to accept for the sale of their property. The loan types we're going to go over tonight is conventional, FHA, VA, USDA, and then, of course, there's no financing with cash, so you don't have to worry about that. But I do want to make note of if you do get a cash offer and it says hard money, that is a hard money loan. It is not necessarily cash. So the deal could still fall through if it's a cash offer, but it says cash/hard money. Anyways, today we have a special guest, Bryce Nerland with Starboard Financial. Thank you so much for coming and joining us tonight, Bryce. Bryce is going to go ahead and go over the different loan types for us. And then he's also going to mention a couple different scenarios, like if you have a condo, why accepting or allowing one loan type over another is beneficial or not. So I will go ahead and pass it over to you, Bryce.
Thank you for having me. So as Tina said, there's mainly 4 different types of loans, loan types that we go, or programs that we go by. There's a whole nother world that we live in called non-QM, which will be some of the stuff that, usually they're still a conventional or something like that, but non-QM, is going to be more like your bank statement loans, your DSCRs, doctor loans, where we're looking at, the repayment of student loans and stuff like that. But for the main part, the main focus, it is the 4. So the one that everybody kind of is familiar with is conventional. And sometimes when people hear conventional, they think, oh, it's 20% down and, all this kind of stuff, which isn't true. One of the cool things about conventional is, as a first-time home buyer, what we classify as a first-time home buyer is somebody that hasn't owned, had a deed or note on the property for 3 years. And so, sorry, got a phone call. And so that means that you can go as low as 3% down payment, which is super neat in a conventional. So again, the difference between conventional and FHA when it comes to mortgage insurance is that with a conventional, it's private mortgage insurance, which means you go through a third-party company, and they're going to bid out the loan and look at the FICO, look at the loan to value, look at different types of where the loan is, etc. And it's going to have a mortgage insurance, monthly mortgage insurance that is put on the property. FHA, the difference is that it's a government-backed loan, so the mortgage insurance is the same across the board. It doesn't matter if you have a 580 FICO as opposed to a 780 FICO. It's going to be the same mortgage insurance. So really, when we as loan officers sit there and kind of look at a profile of a client, is we're going to probably mainly going to look at the FICO score. And really that sweet spot is like 720 to 740. Anything below that is going to usually be on a FHA loan, just for the simple fact that you're going to get killed on the PMI, the private mortgage insurance, on a conventional, because they're going to look at that lower FICO and they're going to think that's going to be more of a risk. And so they're going to, and that's really the basics between conventional and FHA. What are we going to look at? It's the FICO score for the main part. Also on an FHA, you're going to have the upfront mortgage insurance fee that is standard across the board, but that does get financed, so it goes into the loan amount. It's not something that'll affect like cash to close or anything like that. So that's kind of more on the buying side. And then also, the FHA minimum down payment is 3.5%, as opposed to the minimum 3% on a new home buyer with conventional. And those are 2 of the main parts of it. A conventional really doesn't care much about condos or townhouses or any of that kind of stuff. If you do a condo on a conventional, they're usually going to require, the lender's going to require a limited condo questionnaire, which is kind of like just the basic questions about what they got going on. They're not going to dive into it too much. It does have to be an approved condo through FHA, which is a big part of it. And any of your lenders can really, or myself, can help you out with that. And you could probably honestly find it yourself. You just kind of Google search FHA approved condos, and it's going to come up to a search, and you type in there the condo name, the state that it's in, etc. And it's going to show you all the details of when the last time somebody approved that condo for FHA financing. And it's pretty much the same for VA as well. You're going to use kind of the same government website. And really, if you ever see a listing that says, conventional only, that's probably what you ran into, is they probably had a contract on the property and they realized that it was not suitable for FHA financing. And people always ask, like, what does that mean? Why was it not, suitable for financing? Well, a government-backed loan is going to be much more stringent on its requirements of what they will allow to finance on. Remember, in a single family home, it's very simple. It's just, you don't have any shared walls. You live in a regular house. Home insurance is cheaper. The guidelines for lending on them are much easier, as opposed to shared walls where somebody could burn, the building down next to you because they started a grease fire or something. And so that's why the FHA is going to have a very thorough review condo questionnaire of the property, and they're going to ask tons of, it's literally like 40 pages long. It's going to say like, how many investors are in there? Because if it's all just full of investors, they could be easily, have a market change correction where, they can't find tenants and people aren't paying their dues, etc. Tina and I just had a deal a while back where it was a condo and it turned into a nightmare, just for the simple fact that the condo association was not keeping up with what, it was a self-governed condo association, and they weren't keeping up with what their requirements of it were. So always, you got to kind of look at that when it comes to the condo part of it. Townhouse is a little bit different, just for the simple fact that it's more of like a planned unit development. So it's not as stringent as a condo. So that's kind of a leeway there on it. And then into the VA loans. VA loans are my favorite loan to do, for the simple fact that they are probably the best loan. You can get almost pretty much 0% financing, and it's a way to help out our veterans that served. So VAs are awesome. Sometimes it is a little rough when you're on the buyer side. Some people kind of look at the VA loan a little bit differently because they can ask for some fees and need some fees to be paid by the seller. So that's a little bit of the kind of weird part about the VA. The VA guidelines for condos are going to be pretty much the same as like the FHA stuff, as well. And then the final one is the USDA loan, which is a loan that is, we don't do a ton of them. We probably do 3 a year here at Starboard, but really what it is, it's a loan that is made by the government. It's another government loan, and it's strictly made for rural areas. And what it's for is it's pretty much 0% down financing that they can do. And it's meant to bring people out to the areas where not a lot of people live. And it's just promote, like, out in the farming communities and stuff like that. So again, you can just Google search it, USDA property eligibility, and income availability. And it's just going to show up, and you can literally take your cursor, go through the different states, and you're going to find, Black Canyon City, and you're going to type in Black Canyon City, Arizona. It's going to pop up, and it's going to show you if it's green, or again, if it's yellow, and that little part where you're at, the exact zip code of where the property is. If it's in the yellow, it's not available. And if it isn't, then it is available. But then on that as well is there's income guidelines. So you can't make, X amount of money over the mean income of the area. So on that same website, you literally just click on the top and it's going to ask you a bunch of questions. It's going to say how many family members are going to live in the household. Are any of them disabled? Do you have any you're going to answer all these questions, and then you're going to type in their monthly income, and it's going to say if you're eligible to have a loan in that area. So a little bit more work on us on the buyer side, but when it comes to the listing side, I don't really know many restrictions on a USDA, just as long as it's in a rural area. So if you put a USDA on your listing, just make sure that it's available in that area where your property is.
Correct. So from a seller's point of view, if their home has a lot of repairs that need to be done, would you say that they may not want to allow an FHA or a VA?
So it's all going to get called out by the appraiser. So that's everything. And again, remember, an inspection and an appraisal are two different things. But FHA there's appraisers that are straight conventional appraisers that don't do FHA, and there's straight, and there's appraisers that do FHA, don't do VA. Just because the guidelines are a little bit different, you have to be a little bit more qualified to do an FHA because it's a government loan as well, so they're going to get more involved. But yeah, FHA is going to call out issues with the property way more than conventional, right? In a conventional appraisal, they don't even stick their head in the attic. In an FHA appraisal, they're up there looking around, and that's an appraiser, not an inspector. So definitely, if there's a bunch of stuff that needs to be repaired, you're going to way more likely not get called on it on a conventional. VA, absolutely. Remember, the VA appraiser has the best interest of the veteran on their behalf, and that's why they are a VA appraiser. Again, with the FHA and a VA appraisals, they do follow the property. So like we just had a deal where the FHA appraisal came in $42,000 low, and the buyers are trying to, ask to do another appraisal. And we said no, because the FHA appraisal is going to stick with that property for, I believe it's 6 months, close to that. And then again, so what they're going to do, they're going to take it back to market, and they're going to say conventional only, because they want that price, conventional or cash, obviously. And that's how they're going to go about that. So
Yeah, so the point of tonight's class was just to better understand the different types of loans, so that when you have a listing appointment with a seller, these are things that you can kind of briefly talk to them about. If the home needs a lot of repairs, you may suggest they only take a conventional and a cash offer. The USDA, of course, do your research before you go to a listing appointment. If it's outside city limits, see if it's even eligible, because that's a huge option to offer a buyer. And then, of course, if they have had an appraiser, well, let me rephrase that. If they've been under contract with contract one and it was FHA and it came in low and they end up canceling, you're gonna let your client know, well, we can't take another FHA, because if we do, this is what the purchase price has to be, or the price of the home. So again, tonight's purpose was just to better understand the different kind of loan types. Bryce is always available if you have any questions.
one thing I do want to correct myself on, because I just remembered I misspoke. VA appraisals stick with the borrower, not with the property.
Oh,
So
okay.
it's only FHA appraisals that stick with the property. So the VA appraisal sticks with the veteran for 6 months. So you can't say, oh, I'm gonna go back to this property and try to buy it again and get a different VA appraiser to get a better value. So I apologize about that.
But he obviously can do as many, like go under contract on a different home, get a different.
It's the appraiser, the appraisal sticks with the veteran on that property, obviously not on another property, because it'd be different.
Okay, perfect. And then I think the only loan type we did not talk about, which will be a separate class, is a 1031 tax exchange, because that's a completely different beast. Anything else that you want to add, Bryce?
Nope.
Perfect. So again, Bryce is always available for any questions that you might have. Please feel free to reach out to him. Do you mind if I give your cell phone?
Of course.
Okay, 602-509-7137. You can always stop in and see him in person at the Starboard Financial location. He has an office there that's off of Baseline and Greenfield, the 4147 East Baseline Road. Just stop in and
At the ProSmart office, not at the Starboard office.
Oh, yes, ProSmart. Well, yeah, exactly. All right. Well, thank you so much, Bryce, for your time, and reach out if you have any questions. Thank you so much, everyone. Bye.